again. Well, with that, let's move on and welcome our next guest on the show. Anand Shah, head of PMS and AIF investments at ICICI Pru AMC is joining in. Anand, season's greetings to you. Wish you a very, very happy new year, a very promising, prosperous, healthy and happy 2024. So, we were just going through the note that you had shared with us, and I mean, that's really a pretty optimistic commentary coming in. Just for the record, I want to tell our viewers that in that note, Anand points out that India is perhaps already in an upcycle, in a cycle in which we're going to move from B2C to B2B, basically a lot of focus on manufacturing and capex, which could lead to disbelief among market participants. And Anand, I want to start with that because I think this is the biggest challenge with which we're entering 2024, because we've had a 20% rally. Stocks have rallied, especially in mid caps. So one wonders whether, this is getting too much and whether you should lighten and wait for that correction. But is that going to be the wrong approach for this year?
Hi, very good afternoon and a happy 2024 to all of you in CNBC as well as to the viewers. I think it's obvious that too much money is being made in a very short period of time. So investors need to remain cautious. But I think the good news part of the thing is that this market's been led by earnings. I think over last 3 years, especially 3 to 4 years, contrary to the challenging macroeconomic situations that we are in from time to time, be it high inflation or lockdowns and more recently, strengthening dollar and rising interest rates, I think the earnings surprises have been consistent and fairly solid. And when I break down the overall earnings growth rate within the index also, we see the manufacturing and manufacturing allied businesses, including within the financials, the corporate banks, the PSU banks have shown a far better surprise on earnings. And this is all because, we've been talking about this for the last 2 to 3 years, that for almost a decade and a half, China was exporting deflation to the world, which was a good news for consumer-facing, the B2C businesses, but it was a very challenging period for the manufacturing and manufacturing allied industries. I think that was changing slowly and gradually. We had a change of regime in China, we had a change of regime in India. Both actually led to some bit of revival, slowly and steadily revival in manufacturing and manufacturing allied. Last 3-4 years have been pretty solid. A bulk of the earnings surprises have come in this segment. We believe the balance sheets have improved in these businesses, be it in power generation side, T&D, capital goods, even in metal manufacturing, general manufacturing. The balance sheets have improved, debts have reduced, profitability has improved. So all in all, we believe now the next leap would be the capex. So we have seen a lot of capex coming through from government, but private has been reluctant. Now, since the balance sheets have improved, the bank's balance sheet is also very, very solid with a very low levels of NPS. These two combination can lead to a private sector capex leading the growth story in next few years. That is the whole point in that outlook.
Okay. Another theme that you're betting on is increasing urbanization. Your report reads, this is the report for the outlook of 2024, among the large economies, India still has one of the lowest urbanization levels of around 35%. And this is a number which will increase. Now, what about real estate? Now, real estate has come out of a very long period of sluggishness. Last year, the Realty Index gave a return of 80%, and yet many stocks like DLF are very far away. In fact, most of the real estate stocks are very far away from their all-time high levels. Are we getting into a big real estate upcycle, which could last for 5 years at least?
So again, the key challenge in the real estate would be that and what happened last time in 2007, 2008 was the prices. I think as long as incomes grow and the price of the real estate also grows in line or a little less than that, it's a very good news. Even in India, if you see, many of the pockets where the prices have been stable to flattish, be it like the city of Ahmedabad or Bangalore, the real estate has actually done well. It's only when the price moves drastically up is when the affordability becomes a challenge And to that extent, volumes suffer, and eventually the real estate companies in those regions also suffer. So I think the trick would be post-RERA supply. I think the supply should match the demand, and to that extent, prices, if they remain benign, it's a win-win for consumers, it's a win-win for government revenues, as well as it's a win-win for the real estate companies.
You know, there's one contra view on real estate. They're saying that currently the demand is higher than supply because so many projects are getting under redevelopment, so they're unable for use. So, you know, people are flocking to the, the units which are available. But in the next 2 or 3 years, a lot of the under construction projects in, in the city of Mumbai and other metro cities, especially the redevelopment projects, will come on board. That supply will be available. And therefore, at that point, there could be an oversupply. Is that a bit of a risk, according to you?
So indeed, as I said, look, Mumbai is a unique region, but outside Mumbai, the land is not a constraint. And to that extent, I think supply, demand is not an issue. If you ask me, India needs lots and lots of dwellings. And the only reason why we can't migrate so many people from agri economy to the manufacturing economy or a services economy is because we are not able to provide their housing in the urban India. I think to that extent, again, I'm repeating, but demand is not so much of an issue as long as the supply remains, supply comes through, and supply comes through keeps the real estate prices under limits within the purchasing power of the common man. I think that's the key for a sustained growth in the real estate industry. But overall, as we've written in that report also, we believe this time we should see stable prices, improved supply, and to that extent a sustained growth in the real estate demand in the country.
Okay, hi Anand, good afternoon, good to see you in. Anand, which pocket of the market would you be a little bit cautious on then? You know, things are looking up, various themes as you've mentioned. What do you think has already run its course?
No, so we've been sort of underweight consumer staples. A lot of consumer names we've been broadly underweight not because they're not doing well. It's just that either they have a challenge on volumes, or they have challenge on margins, or they have challenge on both of them. But the bigger challenge in that consumer names have been the valuations. That from 2007 till almost 2019, 2020, that was the only game in the town. People literally bought only B2C businesses, and they all got re-rated significantly in that decade. I think that's the area we've been remaining underweight. Separately, we've been underweight IT sector also for last 2 years. Again, 2020 and 2021 were not normal years. The strong growth that we saw in IT sector in 2020 and 2021 was one-off. People extrapolated that and said this is a new sustained growth in the IT sector, and they gave a very high multiples. I think what we have seen in last 12 to 18 months is unwinding of that euphoria, unwinding of that multiple. So I think at some point of time, Indian IT sector will also be good to invest. That's something we have remained underweight in.
Okay, but you're underweight as of now. Got that, Anand. We'll leave today's conversation on that note. Good notes to keep in mind. Thank you very much for joining in, and we look forward to more chats as the year rolls out. That's a view from ICICI Prudential AMC on the AIF and the PMS side with Anand Shah. Let's just quickly come back.
Thank you for watching CNBC TV 18, and do follow us on all our social media platforms for news, updates and more.